Okay, on to part 5 of why does the United States of America do this to me? In the last video, we went over an example that showed how this interconnected system of nodes, the economy, you have this big system of interconnected nodes. We gave a hypothetical example to show how the failure of one node in this system with Joe's Gas and Go can spread out to other nodes, or rather will inevitably spread out into other nodes. That in this interconnected system, you cannot affect one node without affecting some other node. In this video, we're going to go over the consequences of a failure for Wells Fargo. And the first step to doing that, and kind of the easiest way to get a handle on the risk involved, is just to assume that Wells Fargo fails overnight. Okay, it's Wells Fargo they get their charter yanked, and all of a sudden they're unable to do business, as a result of the crimes against me. And then once we've established part of the picture, substantially part of the picture of what's going to happen if Wells Fargo fails overnight, it's easier to understand of what's going to happen if, say, the Justice Department announces criminal charges against Wells Fargo. That you'll see kind of what's being threatened with those criminal charges, given that inherent in those criminal charges is the possibility for Wells Fargo to fail, for Wells Fargo's business charter to be revoked by the OCC. As I've said, the crimes against me would essentially put the onus on the OCC to revoke their charter. And so the first thing, and this is not on my list here, which I've got a partial list of some of the factors that create the systemic risk. And this consists of a lot of different things here, but I don't have listed one consequence, which would be that if Wells Fargo's charter to do business was revoked, the value of Wells Fargo's stock would immediately go to zero. The last time I checked, Wells Fargo had a market capitalization of about $170 billion. Okay, market capitalization, that's the aggregate value of Wells Fargo shares that are out there. Okay, so all the people that hold, however many people hold Wells Fargo stock, pension funds, individuals, investment firms, whoever holds the stock, the aggregate value is about $170 billion. And so there's going to be $170 billion instantly lost by all of those parties. And this can cause some significant damage itself in terms of causing a sudden sell-off of bank stocks, which might trigger a sell-off of stocks in other sectors, loss in confidence in the financial markets. All kinds of things could cascade from that individual aspect of this alone. Just the fact that you're going to lose the $170 billion that's tied up in this stock. It's not pretty there just with that event in isolation, and that is the least of our worries, as we will see. And so here are the factors of systemic risk. I said, Wells Fargo, they're a source of capital. Okay, and so on one level here, we have that, the businesses need capital to function. Okay, capital is an essential component of businesses. And Wells Fargo, being such a huge bank, they fulfill, that they supply, they're there for a large portion of that demand. Okay, and on another level, which is more consequential, is that Wells Fargo is not just that they're there to provide capital, they're an active source of capital for millions of businesses. Okay, and so Wells Fargo disappears overnight. All of a sudden, all these businesses that rely on Wells Fargo for capital, they're going to have to find alternate providers for their capital. They're going to face, a credit crunch. They're not going to be able to afford equipment purchases and so on and so on. And so this would be a problem. Again, essential services. There are all kinds of essential services that banks like Wells Fargo provide. But we'll just use the example of credit and debit card transactions, okay? Payment processing for credit and debit cards. So what's going to happen if Wells Fargo disappears? You're going to have, all of a sudden, you're going to have millions of businesses unable to process credit and debit card transactions, okay? It's like their sales their sales that rely on people using credit and debit cards are going to come to an immediate halt because Wells Fargo is out of the picture, and Wells Fargo is processing those transactions for them. Okay, and how many businesses do you know out there? What percent of businesses can survive without credit and debit card transactions? Okay, there's going to be a very, very sudden short-term reduction in the sales of these businesses and also in their cash flow because all the sales that have taken place in the past. What happens with this payment card processing is the customer pays with credit, and there's a processing of those payments that ends up in the short term and being a cash flow for the business. The credit sales get converted into cash by the different people involved in the payment processing, and so these businesses, they're going to have a sudden decrease in sales, and they're also going to become cash flow constrained because they're not going to be getting the cash flows from the previous sales that haven't went through yet, that haven't been cleared and processed. Then this gap in the operating cycle. Okay, this is massive right here, and this is I've touched on this before, but this is where businesses have many businesses. I would say at least 60% of the businesses in America have a timing gap in between when they have to pay their suppliers, when they have to pay their bills, and when they collect on their sales. So, business, it's common to do trade credit. So you might buy some raw materials from your supplier on, maybe net 30. Okay, you owe your supplier in 30 days, or net 60, you owe your supplier in 60 days. Then you might sell to your customer on a net 30, net 60, net 90, whatever the convention is in your industry. And then of course in the intermediate time, between when you get your raw materials, whatever you're getting from your suppliers, you've got to make your product, and this results in a short term cash constriction. Okay, that you're going to run out of cash if you don't have the financing, that short term financing that banks like Wells Fargo provide. So all these customers, these millions of business customers that rely on Wells Fargo to bridge the gap in their operating cycle, they're going to experience some short-term failures. Okay, remember from several videos ago, I told you about how that cash is the oxygen of a business, and the same thing happens to a business that runs out of cash, as happens to a human being that runs out of oxygen. Okay, they're going to go under. And to give you an example of when I worked at Wells Fargo, I worked in the mid-size to the large lending segment of the bank, and so the customers I dealt with would have anywhere from $20 million in revenues. That was the minimum that you would have in annual revenues for me to be looking at your loan, up to unlimited. So we had customers that were in the multiple billions in dollars of annual revenue, and I worked in the agribusiness segment, and we had one prospective customer. Who was talking to one of my offices about getting a line of credit, which these companies will get huge, enormous lines of credit. Even the mid-sized ones, they'll get $100 million line of credit, $200 million, $300 million, $50 million. You get these large lines of credit. But this customer, in his business, he dealt with commodities. So the inputs to his business that he uses for his business, the inputs are commodity inputs, and the outputs of what he sells to his customers are also commodities. And so he has accounts set up with commodities brokers where he can secure prices for the commodities he buys and for the commodities that he sells. And how these work is you have a margin account. Say that you're going to purchase some grain. Okay, you've got an account, you've got the right to purchase some grain or whatever, and the value of the grain changes, you have what's called a margin call. Okay, you have to keep so much skin in the game. So say that your margin, you've got to maintain 50% of the value of this grain that you're contracting to buy at all times. You got to have, your account's got to have at least 50% of the value, and the value of the grain goes up. That means you got a margin call, and you might have to pay $3 million, $4 million, $5 million, $7 million, $10 million all of a sudden in your margin account, or you're going to lose your grain. And one of the questions he was asking was he wanted to make sure that with this lending facility that he gets, if he gets a margin call, that his money is available almost instantaneously. Okay, when you go through a bank like this, and you go through a bank and you borrow $100 million, $200 million, whatever it happens to be, it's not always the same as getting a credit card where you can just swipe something instantly and get some money. You have to contact the bank and draw on your line, and there can be some processing time involved between then and when you get your money. And the tone that I got from this guy's communications, the tone of his communications, were that 24 hours is for sure way too much. Okay, no way in hell he can wait 24 hours. 7 hours is probably too much. Like when these people make this margin call, he needs his money like now. He has very, very little time to wait, and if he isn't able to make that margin call, that's going to be the end of his business. Okay, he's going to have a short-term failure. And that was why he was so concerned about this and was pressing this issue. So to do a hypothetical there, so say you've got a cattle feedlot. Okay, they're going to buy some grain. They got some grain from a grain dealer. Let's say they got some grain from a grain dealer, and they've got to pay their grain dealer in 90 days. And, then it's going to take them 6 months to feed a cow to get it fat enough to go for slaughter. And so they got all these cows they're going to be selling for slaughter. And all of a sudden, Wells Fargo comes out of business when their suppliers, when their bills, when it's time to pay the supplier. The supplier is going to foreclose on their trade collateral. Okay, so if the company's bought grain from the suppliers, the supplier is going to take back the grain. Okay, the cattle feedlot is going to fail in the short term, and the sad thing is, even this supplier that's reclaiming the grain, depending on their business and how they work, they might experience a failure in the short term too. If they're in a situation where this one feedlot, it's a massive cattle feedlot, really big. If that's the majority of their business, then the grain dealer is going to go out of business, and they're foreclosing on their grain. They got to get what they can because they're about to go under, and so you will have one of these cascading effects, just like I described with Joe's Gas and Go with this feedlots. Where all these nodes all over the place start to fail, and be impacted in a non-zero fashion. And when you multiply that from this one cattle feedlot to all these other businesses in every industry under the sun that rely on this short-term credit, and they start to fail, so they're going to start to fail as a combination of one or more of these two right here. They're going to fail from not being able to process credit and debit card transactions. They're going to fail from a short-term capital constriction, and you start to see how node after node after node starts to fail, starts to experience stress. The stress begins to impact other nodes, and this begins to compound. It is a nightmare. Okay, then this right here is a multiplier effect. Syndicated lending, and what this is when a company, a very large company, or a company that has a need for a large amount of financing. Okay, that they need, they need a loan of $50 million. They got a $50 million loan, $100 million, $300 million, $1 billion loan. They need that kind of financing. That company does not borrow from one single bank. That company will borrow from a syndicate of banks. Okay, it'll be a group of banks that each bank provides a portion of the funding. That banks are not allowed by the regulators to have too many eggs in one basket. And so if you've got some a massive publicly traded utilities company that wants to borrow $5 billion, they're not going to let one single bank take that whole $5 billion exposure. What's going to happen is you'll have a credit agreement for this loan. It's a hypothetical loan to say a massive publicly traded utilities company. It's got a $5 billion debt they're taking out. And the credit agreement will be 800, 900 pages, 1,000 pages. It will be a massive credit agreement. In the first 3, 4, 5, 6 pages will just be a list of all the banks that are participating in this funding. And you'll have Bank A is contributing $300 million. Bank B is contributing $100 million. Bank C, and actually, depending, I don't know the conventions, but even providing $300 million or $100 million for some of these loans would be too much. It would be too much exposure for a single bank. And so if you figure that a bank might be able to provide at most, let's say $50 to $100 million in a loan like that, if that's the case, well, you can multiply that. You're going to have, however many, 50 million to 5 billion. What's that? 100,000? Would that be? Or no, that would be. Sorry, I'm getting lost here. 50 million. That would be 100 banks would be involved there. I got my math mixed up. And again, I can't remember the exact, how this works in different, in that specific industry, I don't know. I can tell you that in most industries, the most that a bank will put up on its own towards any loan will be about $100 million. Okay, but I'm getting long-winded here. The point is that when you have these huge loans, that you'll have a syndicate of banks providing funding for those loans. And what happens is the customer, the company that's borrowing, will deal with an agent, what's called an agent bank, and that'll be the customer's point of contact. And say it's a line of credit. When the customer needs money, when the company needs money, they contact the agent bank through whatever system, whatever portal they've got to draw on their line of credit. And the agent bank distributes that request to the member banks that are participating in the syndication, and each bank will contribute their pro rata share of the funding. So say they got a $300 million line of credits, and they've got 6 banks providing $50 million each, and say that they get a request for $100 million. Well, then it's going to be divided 6 ways between those banks. But the point is that Wells Fargo, if Wells Fargo fails, the interruption in the flow of credit, like these gap in the operating cycle, source of capital, etc., that doesn't just happen for Wells Fargo's direct customers. It happens for the customers of dozens and dozens and dozens of other banks as a result of Wells Fargo participating in their syndications. Okay, and so here we have yet another ripple effect because Wells Fargo, they got millions of customers, then you extend to the customers of these other banks that it's going to be even more widespread, and God only knows what they're going to have to do about this. Then social contagion. This is probably the mother of all risk that can be created by a bank failure, or even by the threat of a failure of the bank. What this refers to is the fact that every single bank in America, and almost certainly I would say every single bank in the world for that matter, at least in every developed country, the bank's very developed nation, are insolvent in the scenario that even a small percentage of their, a minority percentage of their customers wants to withdraw their money. How it works is, you go to a bank, or a bank. How it works for a bank is they take in deposits, and of those deposits, they're only required to hold on reserves. About 10% of them, they're allowed to lend the rest of them out. So say that you go, you're a business, and you go and you deposit $1 million into a checking account. You started a checking account with a bank with $1 million. Okay, now of that $1 million, the bank is allowed to lend out $900,000. And so say the bank lends out $900,000 to an investor who's buying a high-end investment property for $900,000. So that investor borrows the money, he uses it to cut a check to the person he's buying the property from, and the person deposits that check in their banking account. So now this person's got $900,000 in their banking account. Now, when you look in your checking accounts, what do you see? You've still got $1 million. The amount of money in your account hasn't changed. And so we have this thing where magically, $1.9 million has been created out of your $1 million. Okay, that this other person, they've got $900,000 that they can draw on in their bank account and that they can spend, and your bank has held on to 10%. And this is a positive thing for the economy because it has an effect of multiplying the amount of money, the amount of credit that's available in the system, and it allows the economy to grow at a faster rate than it otherwise would. The consequence of this, however, the fact that the banks are only required, and of course it changes. The regulators can change this. They can move it up and down, but for the majority of the past about 20 years, as far as I know, it's been at 10%. But the fact they're only required to keep 10% on reserves means that if 10% or 15% or 20% or 25%, depending on the bank, some minority of their customers wants all their money back, the bank becomes insolvent. Okay? Now, if they don't have the cash to meet the demand for these deposits, and the bank is going to fail. Banks just work like any other business. They run out of money. They fail. And social contagion is a phenomenon where there begins to be a widespread fear of the stability of the financial system that leads to this thing where customers start to want to withdraw their money from banks, which is called a run on the bank. That we have some isolated event with one bank or some isolated event that's threatened or whatever happens, that all of a sudden there's panic in the financial markets, there's panic among the public, that they start to fear about the security of their money, and they start to go and withdraw their money en masse from whatever banks that these people bank with, and when this happens, this is the end of the world. And I guess one way to state this is that all that stands between a functioning economy and the literal end of the world every single day is the public's faith in the financial system. And so if the public loses their faith, if they start to panic, you're going to have failure after failure after failure of bank after bank after bank after bank after bank, and it will bring the economy of the entire world to its knees in a way that it cannot recover from, and it would be even potentially lead to the collapse of the financial system itself. Okay, taken to an extreme, we could end up back to a barter economy. And with the failure of a massive bank like Wells Fargo, or even the threat of a failure, very, very likely to consider that it would trigger one of these social contagion effects. So I'm getting really bad off. We're going to have it continue in the next video.